growth in China is headed towards a structural slowdown. And that paradigm shift that we're describing in terms of the policy planners, what they're trying to do, and the reality as it's going to play out has very serious implications, and the policy priorities have completely changed.
All right, everyone, welcome back to another episode of On the Margin. Today, I am joined by Shehzad Qazi, who is a managing director at China Beige Book. Shehzad, welcome to the show.
Hey, thank you for having me on.
Even before we get into what's been going on this year, can you just give us kind of a 2022 year in review of China, and then we can kind of dig into what's been happening so far this year?
Yeah. So, 2022 actually started off, people can remember, on a positive note. We were actually seeing the Chinese economy rebound from what was a mild slowdown at the end of 21. And you were especially seeing the services side of the economy and consumption side of the economy finally rebound. And things were looking really good till you had the Omicron outbreak hit China. And then you saw that the government, starting really from the spring, really from March onwards, starts to get really nervous and shuts down eventually Shanghai. And then you have Beijing go down into a de facto lockdown. And what you get over after that, over the late spring, summer, through the fall, and then through, till up until end of November, is a repeated series of lockdowns under the so-called zero COVID policy that had existed in China for, the year or so prior to that. And all that good news and upbeat sentiment that you were seeing in January and February after the opening of 2022 just dissipated. And what you got was one of, just a successive weakening of the Chinese economy quarter after quarter, or sometimes month after month. And the year just became one of the worst on record that we have had inside of China, outside of the early 2020 slowdown that you saw when COVID first hit. So 2022 being from potentially a positive year from the Chinese economy to being, as I said, one of the worst.
So maybe starting at that end of 2022, let's dive in a little bit to what's been going on this year. And from what I can tell kind of from the report, there's a little bit of a tale of two Chinas that's going on right now, because you still have some depression and stress when it comes to the real estate sector. But in terms of the economy, we're actually starting to see things pick up in terms of business activity. So could you is that your sort of assessment as well? Can you kind of walk us through those two areas?
Yeah, I think the tale of two Chinas is, I think, a good way of looking at it. Now, what happened at the end of 22, of course, is that we got the about face from Xi, essentially, right up top, right? We went from having zero COVID to essentially having total COVID, scrapping off all lockdowns and restrictions. And then, of course, you saw just the eruption of coronavirus cases throughout the country, especially in the bigger cities. And then, it's, of course, as predicted, it spread to the rural areas, especially during the Lunar New Year holidays as they were starting to take place. Now, the expectation once zero COVID was scrapped was that you were going to get a bombastic recovery in 2023. A lot of the people positioned, as a matter of fact, markets positioned to say, look, you're going to get revenge spending in China. You're already seeing a property sector easing going on. And that's going to essentially be a property sector bailout. And the government will probably come in with additional stimulus. So there was you're talking about oil price targets, for example, coming out at over $100. This is what I call sort of the mega bull thesis on China that came about at the end of the year. Now, come to January, and you see that big spike in consumer spending. You see the travel and hospitality gauges just skyrocket. Manufacturing wasn't doing so well right at the beginning. Taking that story forward into February, what happens? This was the key month in order to understand, look, are you really getting that revenge spending surge and from here onward it's all take off? Or is this going to be in fits and start till the consumers feel more confident? And the data suggests that it is not a upward trajectory story. Consumer spending, especially on travel and hospitality, et cetera, pulled back. Consumers have pared back a little bit. However, on the positive side of the story, you are getting a manufacturing sector that is doing a little bit better. And I think very, very importantly, you're finally starting to get a sense that the property market is turning a corner compared to the absolute horrors of 2022, especially late last year. You're finally starting to get a bit of a recovery in the market. The year-over-year picture is still grim, and I think it'll take a second for that to turn around. But nevertheless, I think that's a positive story. So as you said, you are getting currently that tails of two China thing going on.
Now, let me ask you some specifics on that. So I love that phrase, that revenge spending. You certainly saw that in the US, right? When the lockdowns were lifted and we got the vaccines. Why do you think that we're not seeing something like that in China? Why do you think that kind of curtailed in February?
I think there are a few things that we can talk about. The whole thesis that there's going to be revenge spending rests on this idea that during the pandemic, Chinese households have accumulated a mountain of savings, and as soon as they're given the opportunity to spend, they are going to go out there and spend. Now, that I think is very, very wrong-headed and certainly misleading. And it's important to understand that the savings that sit there in the bank accounts, regardless of how high the number is, and there's no consensus on that either, it's coming from the fact that people are saving for a rainy day. The macroeconomic conditions have been so bad that saving your money is the smart thing to do. It's not just the lack of opportunity to spend. The other reasons I think you've seen, especially among the wealthy, which is where the savings have jumped, is that property is typically the place where people put their money. But property is no longer a reliable investment asset class. And so the money that was intended to go there is currently just sitting in savings accounts. That doesn't necessarily mean that people are going to take the money that is intended to grow their wealth and just go buy an expensive handbag with it or go take a trip to Paris or Florence. So those are two things I think I want to caution right up front. Coming to your very specific question, why is it that consumers have pared back activity? I think some of it is certainly seasonal. What you got was a bump that was driven exclusively by the Lunar New Year. And now that people are back to their cities, they're either looking for jobs or they're back at work. Some of that is going to die down till, of course, you get into maybe the late spring or the early summer. But a broader context is always important. The labor market in China still remains significantly weak, right? There's a very serious employment problem that's going on there right now. And I think that by and large will continue to constrain, even along the way as you get better consumer spending results, will probably put some downward effect on the overall state of the Chinese consumer.
That's very interesting, Shehzad. So one question that I sort of have for you is how much of the activity, kind of that change in China for this year, has been a result of kind of this credit impulse from China and liquidity conditions? We've definitely seen the PBOC take a very different tone, and there's kind of a reopening, and there's an injection of stimulus going on in the China economy. So how much, of this data do you attribute to that?
Yeah, I think the property story is certainly one where stimulus is really the driver there. What you have seen happen over the last several months is there is most certainly a better credit access that is now available to property companies. Mortgage rates have declined. So there is a desire, the Beijing spent the last year and a half prior really trying to deflate this bubble and go after the problematic developers, Evergrande being one of them, but certainly not the only one. And now there has been a policy shift that we now need to resuscitate the sector. We now need to have these unfinished projects taken care of. And of course, we need to provide the companies that are healthy and are going to be the future of the real estate market and help complete the projects and carry forward. Let's make sure that they don't start running into problems. So let's make sure that they have access to, there's ample liquidity in the system for them as well. That goes a long way to spurring this revival or recovery, I should say, not revival, that we're picking up in property. Stimulus is important there. The other thing, of course, is that the manufacturing sector also is getting pretty good credit access. So you are starting to see banks now being much more willing to lend. There has been top-down pressure to lend as well. That said, the rest of the year is not, in my opinion, going to be, what, again, the consensus seems to be out there, that you're going to get an organic recovery and you're going to get stimulus. I think you're going to be, it's the story for this year is organic recovery versus stimulus, right? So if Chinese households don't really come out and spend as much as we expect them to, and the property market recovery either stalls or sputters, then you get a pretty serious, I think, stimulus effort on the fiscal and monetary side. But if you are getting the organic recovery, well, then it's actually very good news for Beijing's policymakers. They get to keep stimulus in their back pocket, perhaps to be used next year.
Hey everyone, thanks for tuning into the show. Just wanted to give a quick shout out to our sponsor, Public. Public is an all-in-one investing platform where you can invest in everything from your basics, so think stocks and ETFs, to alternative assets, think fractionalization of fine art. They've got crypto on there, which you guys know that I think is super cool. But the thing that I want to talk to you today about is treasury accounts. So big caveat here is this is not financial advice or investing advice. You guys know that I don't give that. That being said, the story of this year is climbing interest rates in the United States. Public.com, as of today, which is March 7th, allows you to get 5.1% in yield from their treasury account. That is 5.1% in yield coming from the US government. If that is something that interests you, I highly recommend that you seek it from public.com as opposed to other sources, and I'll tell you why. Right now, if you want to go try to buy a treasury bond from the US government, you got to go to something called Treasury Direct. It's a site that was designed in the 1970s and it hasn't been updated since. For my 5-year-old brain, it's just way too complicated and clunky, can't figure it out. I prefer to do it on Public, and here's why. There's no minimum, there's no holding period, super easy UI and UX, very easy to understand, and they'll even reinvest the bonds at maturity if you want them to do that. So for me, it's Public. I highly recommend that you check them out. Click the link at the bottom of this episode, and guys, tell them that I sent you because you know me, I love my credit. For some of our viewers who might not be quite as familiar, can you kind of start to get into the differences in between how the Chinese system works and the American system kind of works over here? Just to go back to one of your previous points about banks being more willing to lend, I recall in one of the earlier interviews with Leland, he kind of outlined a difference in that in our banking system, there's a big focus on counterparty risk. That doesn't exist quite as much in China because the state can just dictate which counterparty should lend to whom, right? Which is kind of a funny feature of that system. Yeah. But can you just kind of start to contextualize for us how we should be interpreting some of this data given the different kind of top-down structure of the Chinese system and the CCP? And then, let's start there.
Yeah, and so in a nutshell, the Chinese banking system, outside of the some private banks that you have, is by and large a non-commercial financial system. In other words, whereas the big players here are what we commonly refer to on the investment banking side as Wall Street, or on the commercial side, of course, you've got all the major banks that we're familiar with, whether it be Bank of America or JP Morgan or Citibank or other international banks that also operate in U.S. territories or worldwide, really. You have those as the core players. You don't have really government-owned banks that have, and right, it's not like the Federal Reserve, for example, has bank branches out there which lend to businesses or lend to households. In China, of course, the reverse is true. The biggest banks, the big 5 they used to be, now they're the big 6 or big 7 even, are all government-owned banks, whether it be the Bank of China, the ICBC, et cetera, et cetera, et cetera. So the lending structure there is very tightly within the hands of the state, which means that the policymakers in China, have the ability at the national level and at the provincial level to exercise that type of political control and decide and they can most certainly decide the winners and losers that way, by saying you must lend to this particular industry or these particular firms, right? So historically, what have you seen? Large companies are some of the biggest beneficiaries of credit. Large companies oftentimes also happen to be state-owned companies. So state-owned companies have also been biggest beneficiaries of either cheap access to credit or very easy access to credit, however you might want to put it. Oftentimes, for example, you'll see that SMEs, and it's because especially they happen to be private companies, struggle to get access to credit in the same manner that large firms do. Because there is a very clear idea that, look, you can lend. Now I'm deviating a bit, but this is an important point for the audience that, a state-owned company and a large company, you give them the credit, it is going to be backed by the government. If there's a default, there will ultimately be a process through which the bank's books will be cleaned out, as we kind of just saw happen in the case of all the defaults that you saw in the property market, right? There's this ongoing game of how money moves around in the Chinese financial system, but the state ultimately backs up these state-owned companies. or these oftentimes these large companies. SMEs don't have that, and SMEs will often find themselves, unfortunately, therefore, in the back of the line when it comes time to access credit. But that's a big chunk of it, and it's related to another point, by the way, for the audience to understand. Uh, when you get things like big defaults in China, you'll often hear, or the risk of defaults in China, you'll often hear people out in the West and the United States say, oh, well, this is the Lehman moment. When Evergrande happened, everybody said this is the Lehman moment. In China, it's a different story because the government owns the banks. The government has, for better or for worse, normally for the worse, the ability to socialize the losses, just step in and do the bailout. It's not like here where the sitting Treasury Secretary has to get all the major banks around a table and then beg them to take care of the problem and then try to work out a deal. It doesn't work that way there. The party directly controls the financial infrastructure that way.
I was, just thinking to myself when you were describing some of the challenges for SMEs as opposed to big businesses. The challenge, though, of course, for businesses is if you get too big, then you can have a Jack Boss situation, and nobody might hear from you for a month, right? If you're running something called Ant Financial and you start taking away from the money market funds over in China, so it's a tough line to tread for the businesses over there.
Yeah.
Let's start to talk a little bit about the impact that China might be having globally. So I think maybe that the kind of interesting area to start there is around commodities, right? There's been a lot of speculation. You kind of mentioned oil before, but even other sort of more industrial commodities. China's a large consumer, right, of commodities. So I'd be curious, maybe just starting through the lens of, let's just say oil or something like that. Does the China reopening have a chance to, does that create more demand for oil? Should we see that kind of reflected in the price of oil? And just how do you see the reopening kind of impact commodities across the world?
Yeah, the reopening story by itself, right? Should there be China-driven demand jumps in the demand for China-driven jumps in the demand for oil, for the demand for iron ore and copper? In theory, you would think that is the answer is yes, because now that the economy is opening up, and especially because there's easing happening towards the property market, there's a sense that you're getting some fiscal activity taking place. All that is very positive. And I think the speculation or the ideas around being bullish on commodities makes a lot of sense. For example, if you look at our February numbers, if you look at the fiscal activity tracker, we have a proprietary fiscal activity tracker where we say infrastructure development firms, are they selling more projects? Are they are new projects getting started? Are they hiring more? Are they investing more? And we take that and we put that together in an index. And what we see is that there's a massive jump in February. That's a very, very positive signal if you're a metals trader, for example, especially we're talking about iron ore and copper and so forth. The idea is, are people going to get too carried away with this, or have they? Again, coming back to what I was earlier referring to as the mega bulls or the super bulls. And I think there is a bit of getting carried away with this, because the idea that China's spending by the consumers, for example, this year within China on travel and on so forth is going to break pre-pandemic records. I think that's very aggressive. Can it go back to around pre-pandemic levels? Sure, but will it necessarily just break all records or break those records even? I think that's a very aggressive position to take. We're not, it's not a magic wand. The economy does need time to recover. Consumers are typically conservative there. Again, upward trajectory, no doubt about it. Much better than last year, no doubt about it. But certainly better than many years past. I think that's where they're getting carried away. Same thing with the stimulus idea, that you're going to get stimulus no matter what. I don't think so. I think stimulus is going to be used in a manner, in a way to support the economy, but only if it's needed and where it's needed, and the size of the stimulus is still not fully known, or it cannot be known. I think at this stage. So this is one of those interesting years where there is no reason to be bearish on China. Everybody should be a China bull. If you're not, I want to know why. But there are certain folks out there who, again, I think are getting overzealous maybe about this.
Yeah. I think the reason why so many folks like to focus on oil is oil, and just the price of energy sort of writ large was an enormous component in kind of the global inflation story that we've had over the course of the last couple of years, right? We did for listeners who caught this episode, an episode with Michael Cow about how, his thesis is inflation kind of started in energy and then kind of leapt over into some of the stickier components of CPI. Obviously, also a high price of energy tends to coincide with big recessions as well, right? So big kind of warning sign when we see spikes in energy. If we're looking over in Europe, right, we've kind of steadily seen inflation actually ticking up, and there was a big surprise over this last month, to the positive and kind of the bad side overall. So I guess my question to you is, how much of this kind of re-acceleration in inflation can we ascribe to activity in China?
Yeah, that's going to be the key thing. Everybody is trying to gauge this here, including the Federal Reserve. They've been very concerned about China. And China, as a matter of fact, has been kind of a blessing to the Fed and to maybe other central banks as a result thereof for the last couple of years, and especially all of last year, because zero COVID meant that a lot of the inflationary tendencies and push, just did not exist. How large, or how much of it will come from China this year? Let's look at the data first. So the data right now, as we wrote in our note earlier this week, is I think giving a sigh of relief to both policymakers inside of China and, of course, places like the Fed, because inflation is still very, very low. I don't know how big a push we get. Do we get inflation spiking this year? Again, I don't think so. I think the recovery, is going to take its time. And even when growth jumps and the consumer is getting reactivated in Q2 or in the summer, I don't anticipate massive jumps in inflation from where we are, because the levels are so low where we are right now. I think it'll take time, to really start to see that upward momentum coming in from China. So I don't think that China will be the big driver of inflation this year. And let's, again, it's very important to keep something in mind. You could have inflation rising within China, as in because of demand. You could have commodities demand rising in China, which of course is the point you're making, which it inflicts higher prices, pushes up prices of commodities higher. But in terms of other things, whereas export-driven goods, if demand for exports is declining, for Chinese exports is declining, Chinese producers and exporters will not be in a position to naturally start hiking prices, right? So the inflation you'll get from Chinese production, and as they are reflected here, I think it's important to keep that element in mind as well, which I think has that sort of effect on Chinese inflation.
I've got a question, Shehzad, for just how you think about kind of the interrelationship in between the economies of China and the US. So, you kind of think about it to drastically overgeneralize, right? You've got kind of this consumer demand-driven economy over in the United States, where the U.S. consumer is kind of this engine, right? And then you've also got kind of that China is the factory of the world, and they make all the stuff, right? And that's been the relationship for a long period of time. So I'm curious, actually, how there's a lot of focus being paid to, well, how is the China reopening going to impact everything else, right, over in Europe and America? But how is a potential recession over in the United States possibly going to impact the recovery of China? I'd be curious how you see that push-pull relationship.
Yeah, I think that's the right. So I've been seeing a lot of commentary on exactly what you just said right now. How will the reopening in China impact our economy? And, let's understand something. The Chinese are not consumers of our service exports, not talking about manufacturing exports naturally, right? It's not like we sell a bunch of services to the Chinese economy that now that they're open, all of a sudden that's going to be, a great driver of growth for us. That's not the case. The relationship obviously is the reverse. And what that means is that the recessionary headwinds that we are all concerned about here, and we most certainly are starting to see in the manufacturing sector, and I will see if it extends elsewhere, these are negative signals for the Chinese economy. This is not a good sign for the Chinese economy, because what it means is right as the economy is not ready to produce at say full steam ahead, because they're not doing the bubble format anymore, and within the factories, they are maybe getting over their COVID outbreaks or COVID spikes, at least for the time being, and they're ready to go full steam ahead. Well, right at that point, demand from their clients is going to be dropping. So that, as we had, I think, kind of mentioned earlier in the conversation as well, means that the manufacturing sector is going to stay under pressure, may even see a slowdown, through the rest of this year. The manufacturing sector had already started to slow down. I mean, the rest of the economy wasn't doing too well either, as that was a big driver of it. But I think our recessionary trends here, even if they're going to be shallow, will have a far bigger effect on the Chinese reopening than anything else, and the effect will, of course, be putting pressure on on depressing growth naturally.
Yeah, that makes a lot of honestly intuitive sense to me. Now, this is the one I got to ask you about this, but I know it's very difficult, and this is kind of a mushier area. Nobody's really got a crystal ball, but I feel like every day, right, there's another headline that sort of alludes to this growing tension in between the United States and China, right? You've probably seen the headlines about TikTok, and government officials are going to not be able to have TikTok on their phone. And there was the CHIPS Act, right, which was a pretty big step from kind of the Biden administration to reshore U.S. semi. That interrelationship in between the U.S. as the demand, the consumer, and China as the factory. I mean, how much does this tension threaten that relationship?
I think a big chunk of it, right? So what are we looking at here? So we are looking at the coming many years, probably, of two very interesting trends happening in China. The one that you talked about, and another one that I'll quickly foreshadow here. You have structural issues within the Chinese economy. You have a structural slowdown that is taking place in the Chinese economy, which is a very interesting trend because it'll help determine winners and losers within the economy and all sorts of interesting things about economic growth there that so far many people didn't worry about because they were so used to the idea that China just grows, and when it doesn't grow, the government puts all this money into the economies and things are still great. That no longer is the case. You've got that thing going on its own. The other reason, of course, China is so interesting now and is going to be for a long time is what you just mentioned, the rise in geopolitical tensions within the United States and China, and that a driver of everything that the markets care about. That is here to stay for a while. We are on the road of a decoupling with China. So when I say we, I mean the United States and China are on the road of a selective decoupling. Decoupling that will take place in the area of manufacturing because there is a serious amounts of concern in Washington, D.C. today about the supply chain reliance that we have on China here, especially when it comes to critical industries like pharmaceuticals, critical minerals, technology inputs, and so forth. There's going to be selective decoupling, as we are talking about now, in the technological sphere. This is a two-way street. This is not just American policymakers or lawmakers in Congress being concerned about TikTok and the uses of TikTok by the Communist Party to either censor information or as a vehicle to promote its propaganda, or fake news or whatever you might want to call it, but also Chinese policymakers and their concern about the use of their citizens' data by the United States for the same purposes of surveillance, intelligence, and information, manipulation, propaganda, whatever you might want to call it. There's a desire on the Chinese side to decouple. The Didi IPO that went sour, went bust at the last minute was a great example of that. You've seen the data privacy and protection laws in that country changing rapidly, which are a result of that. You have seen a lot of hesitancy there on the financial decoupling side, and this is where the two meet in many ways, from that data standpoint, right? And the financial decoupling is that third element. You have Chinese policymakers saying, you know what? We don't want all our firms to go to New York City or to go to New York and list over there, because tomorrow American auditors could say we demand, the entire stream of data that you have, which will allow them to learn whatever about us and use it for espionage purposes and so forth, or use it for other ways to undermine us. So we don't even want that relationship. And certain Chinese companies have already delisted from the stock exchange here. Others, I think, will in the future. Many will never show up here. They'll go to Hong Kong, or maybe they'll eventually go to Shanghai. And that's where the financial decoupling comes in, which is also, again, a two-way street, because by the same logic, or in a similar vein, in DC, policymakers and lawmakers, more specifically, more so than any policymakers right now, are saying, we don't like the idea that American pension money, especially of the armed services, goes and gets invested in companies that are working for the PLA, that are working alongside the CCP to make it a stronger national power, or global power, rather. So you have, the manufacturing supply chain stuff, rather. That's perhaps more of an American-driven thing. But when it comes to technology and when it comes to finance, you have, I think, a desire for ultimately selective decoupling on both sides. But this is not, this is, I'm describing to you what the viewpoints are today. How do you make this happen? That's a whole different ballgame because the economies are so intertwined, and which is why the coming years are going to be incredibly interesting and important for markets to watch and understand because we've never been here before.
Yeah. Can you help me understand something? When we talk about this decoupling, I think the natural tendency for most people is to do something very binary and say, oh my God, the US and China relationship is going to break down World War III. And maybe that will happen. I'm not smart enough to know. But where I like to spend time thinking is, let's say that happened on the margin, right? And see the name of the show. There you go, right there. But what if that happened just marginally, right? And let's say that the trade relationship just broke down, say about 25% over the course. I know that's a pretty big difference, but let's say some amount like that over the course of the next coming years. When I think about that in terms of how that's going to impact the United States, we are going to lose access to a very low cost labor pool that we've become really reliant on. So we've kind of got two remedies there, right? We can either onshore everything back to the United States, which I'm not sure is going to happen, but we'll find other low cost jurisdiction to produce a lot of these goods. But either way, there's probably some inflation there while we figure that out and move supply chain. It's going to be labor intensive. My question is, what happens to China on the market? Because they already have some kind of significant headwinds when it comes to growth. I want to get into demographics for a second. But to me, that's them losing maybe 20%, right? In this analogy of their best customer. So what happens on the China side of that equation?
Yeah, I think the whole China economic strategy today, and our chief economist has written a wonderful article on this, Derek Scissors has. The whole program now there is to become a manufacturer of high-tech goods and other technologically advanced products, machineries and software and so forth, hardware and software, and become the supplier of those technological goods to other countries rather than what's going on today where China is the buyer and the user of it. So China is, of course, trying to change its own place in the global value chain as it is. That's number one. Which means, and that national challenge, if in theory the United States ultimately gets more and more and more aggressive, and this is not a given, it's certainly outside of things like some export controls we've seen. We're not seeing, that much aggression out of the Biden administration. I think there are a lot more headlines about things than there is actual action on the ground. And so if that happens, then of course, China is going to be running into trouble. But as I just said, that's not a given. So China is trying to change its own position in the global market. And of course, it's probably ultimately betting that, not enough countries in the world will ultimately stand up and try to, align against China to where it would have to suffer these sorts of issues. This is very interesting stuff that we're thinking about and looking at, because most certainly, the supply chain decoupling that we described is going to have an adverse effect on the Chinese manufacturing sector if it is carried out in full. Again, I say if because there's a lot of talk about these issues right now, and a lot of people increasingly doing risk and scenario planning in a much more serious way. But as we've come to learn, even with things like export controls and things like chips and so forth, the Western world, which needs to, which is up next in terms of it's their move, they are having a remarkably hard time undertaking policies today, at least right now, which are as far-reaching as they may seem when you read a newspaper headline. Right? So even today, when the most sensitive technologies are currently barred, and supposedly there's a deal with Japan and the Netherlands, we don't know what's in the deal. No side has made this public. So it's hard to decipher what's even going on. The rest of things are continuing as promised, right? The Commerce Department is still giving licenses to American companies and other companies to produce other technologies in China and to be able to provide these technologies and technological inputs and chips and semis and so forth to Chinese companies. So it's not like there is this very hard and fast rule about cutting China off, even though that's what the headlines will make it seem like that has taken place here. So this is the stuff that is working out in real time. But so far, I can tell you that the political will and the political capital most certainly it does not seem to be there in such a strong and stellar way as perhaps you might think when you read the newspapers. Happy to talk about that in more detail, of course.
No, that makes a lot of sense. I'm just looking at actually some of the headlines that we kind of aggregated, and a lot of these, it's hard to really dig deeper and figure out how serious they really are. So I'm looking at one of these headlines from The Guardian: China instructs state firms to phase out Big Four auditors, right? Wow. Biden administration approves weapon sale to Taiwan amid tensions with China. That's coming from CNN. So you see all of these sort of headlines, but it's hard to contextualize really what it looks like on the ground. So I think the color that you provided was honestly really helpful there.
Yeah. I think though, if the one point I can make is I think markets are in for a pretty serious ride, wild ride, I should say, in the coming years because of, I think, this exact reason. There is political impetus over here in the United States and other countries to act about the various challenges that China is presenting increasingly from a national security standpoint. The national security viewpoint is certainly ascendant, but being able to gauge inaction from action and action from serious action from severe action, that's a spectrum. And it's going to be, this is no longer about, having somebody just read the newspapers alone and decipher what's going on. It just requires a lot more serious analysis and understanding and knowledge of what's taking place in order to be able to successfully do this and think about the impact on one's investments, whether you're a corporate decision maker or whether you're trading in the markets.
Yeah, very well said. One, maybe in closing, I'd love to kind of get your thoughts overall. You said that this year it would make no sense to not be a China bull, but I'd love to get your kind of longer term thoughts. And there was a statistic, we've talked about it a lot on the show in the past, but there was this recent statistic that stuck out to me, which was China has lost 40 million people. That's 40 million from their labor force since the COVID pandemic, which was a pretty shocking statistic to me. But if you look at some of the longer term demographic work, I think Peter Zeihan has predicted that China is going to lose something like half of its working age population by the year 2050 or something, which is not very far into the future. And maybe we can, I'm going to struggle to actually share my screen here, but I'm looking at a chart where you can look at the rate of births and the rate of deaths in China. And it is actually crossed. So there is the death rate is higher than the birth rate in China. So how much of a headwind really is that? Can you kind of help put some of these numbers or statistics in context for us?
Yeah, the demographic decline is a very serious headwind for the Chinese economy moving forward, and not only because you're talking about the decline in the working population and so forth, but you're also talking about the fact that the whole idea is can China go the way of Japan? The idea being that Japan also got old, but Japan became a wealthy country before it became an older country. China may not reach that status of being a wealthy country. We have to remember, China is by and large a developing country. You leave Shanghai and Beijing and the bigger cities, and you start traveling out, and you'll realize that China, as a matter of fact, is beset with some of the same problems developmentally that other emerging and frontier markets are. So China may become an older country before it becomes a richer country, which of course has all sorts of implications for what China is in the world as a global power and so forth. But the demographic decline is most certainly a very serious headwind. As a matter of fact, a big chunk of that is also why you need that economic model to change, right? Because you cannot just be a country that's the factory of the world if you're going to lose so much of your labor force, which oftentimes relies on younger population. To do the work. So there are all sorts of challenges which, ultimately tell us that the Chinese economy that we are all used to for the last, especially since the global financial crisis, which was an economy that first grew, as I said earlier, at double-digit pace, then it slowed down to something around 7 to 8%, then 6 and some percent, and now, we're looking at about 5 and odd, and it'll continue to slow down. There's a structural slowdown in place. The policy planners in China also understand that. They very much know that this is coming. And they're actually trying to make sure that they can turn this ship around and go from being this economy that has so far been the product of high levels of debt used to generate high levels of investment, resulting in high levels of growth. That the road on that is run out. Even if you were to keep amping up the debt, you really just can't get much more out of it anymore, growth-wise. So you need to turn around and shift the economic model so it relies on domestic consumption of services. But that requires a whole bunch of other investments to take place within the population and so forth. But that's exactly what they want to do so that they can grow at a much more sustainable pace and have a much more healthier economic expansion, and then ultimately make the people richer in that country, become a wealthy country. That's a project that the party has embarked upon and very much understands that the challenges that it's up against. But what that means is, in either case, whether they're successful or whether they're not successful, growth in China is headed towards a structural slowdown. And that paradigm shift that we're describing in terms of the policy planners, what they're trying to do, and the reality as it's going to play out has very serious implications for anybody doing business in China or anybody trying to trade around China and its impact in global growth and so forth.
So maybe let's just, I think we're kind of winding down here, but Shehzad, kind of bookend this conversation for us here. So we've talked about a whole bunch of stuff, like what's happened in China so far this year, economically, what is likely to happen, how does that trickle out? Any just kind of closing thoughts or, summary of the conversation or anything that you want to leave listeners with?
Yeah, I think the thing I want to leave everybody with is that you have to throw out your old China assumptions because they just don't work anymore. And working off of that old playbook leads to a lot of heartache and a lot of pain. I think assumptions like Xi and the Communist Party are always pragmatic, and therefore they will always do what we as market participants think is the rational decision. It doesn't work that way. Think about Xi by studying Xi, but don't try to get into Xi's head because you can't do it. Follow the data. Don't follow what you think or what your assumptions are. Follow the numbers. And private data, I think, have a very big role to play in there. And I think start to understand what I mentioned earlier, that the economy, the next 10 years are not going to look like anything that you saw in the prior 10 years. The picture and has completely changed, and the policy priorities have completely changed. We didn't get into the geopolitical stuff, but you've got the risk of the war around Taiwan. You've got all sorts of things about trying to become the global supplier of high technology. You've got potential pushback coming in from Washington, but all these things are, so there's a lot more risk, a lot more unpredictability, and a lot more uncertainty. And I think markets and decision makers, anybody who has business in China, or as I said, is an investor, needs to start very carefully and systematically, and in a very sophisticated way, start tracking China. That old school model of reading the government's press releases and saying, "Oh well, we're going to get 8% this year, and let's not worry about it." That's done. You're going to lose money if you do that.
Shehzad, this has been super helpful and very enlightening. If folks want to find out more about you or the good work that you do at the China Beige Book, what's the best way to do it?
So our website is www.chinabeigebebook.com. We also have a very active and oftentimes entertaining Twitter account. The tag is at China Beige Book. I'm at Shehzad H. Qazi. You can see the spelling of my name, I'm sure, in the interview. But yeah, follow us and get in touch.
Thanks very much, Shehzad. This has been a ton of fun. We'll have to do it again soon.
I would love to be back. Thank you so much for having me today.
Cheers.